So we were just talking about making a mixtape where you got to bring it down a notch and you got to make it exciting. So we brought it down a notch last time, and now we're gonna bring it back up. So we've got 2 topics to cover, and then I think we'll have covered everything in personal finance. Do you feel confident that that's the case? Not a single person. I am not very good at this. Okay. So investing is the first thing we're going to do. Okay. Has anyone been in the Peace Corps? Seen a Peace Corps manual? No. That's a first for me. Okay. I had a neighbor when I was growing up that had a Peace Corps manual. And it's very interesting what's in there. There's things like how to build an igloo, human resource administrative resources, financial management. So the one that was most interesting to me was how to survive an anaconda attack. So everyone knows what an anaconda is, right? It's the biggest snake, largest one in records, 500 pounds. And that, you see the picture of it right there.
Is that the same chapter as the igloo?
Different chapter. We'll get there. So, I let it out of the bag too soon. You weren't supposed to see that. Did everyone read it?
Yeah, I read it.
Oh. So how do you survive an anaconda attack? Give me ideas. If you read it, not a word.
Stick your fingers in his eyes.
Okay. Usually it's not get close. That's not the first thing you do. So usually when I ask that question, now that I've screwed it up, is people say you run. But you don't run because they're faster than you. They can go 12 miles per hour through brush. You can't go 12 miles per hour, right? So don't run. Lie on your back. Lie flat on your back. Absolutely. Lie on your back. And I love this part right here. It says, do not panic. The anaconda will climb all over your body. Here's it. It tells you how to feel. Be calm.
But couldn't it just smother you by just flopping on your face?
It won't. So why do you think it goes all over your body?
It tries to find something to grab onto.
It's trying to find, because you're warm. You're obviously something that's a tasty morsel. So it's trying to find where it's going to begin. Okay? But again, right, it's going to begin swallowing your feet, so it's going to crawl all over you, and it's going to circle and go over it, and it's going to find, oh, here's the narrow spot. We're going to start there. Why does it start there?
Because it's sticking up.
It's because it's thin. When you have an appetizer, it's the small bit, right? Get your stomach kind of ready. So it's starting where it's small. Because remember how it does it, right? Its mouth has got to expand over. So it's got a hard time going here, so it starts down there. But remember what it tells you. It says, be calm. So why do you have to be calm? What happens if you move? It knows you're alive. It strangles you. It tightens around you and kills you. Then you can't win right now, because now you're dead, and it's going to eat you anyways. So, okay. So permit the anaconda to swallow your feet and ankles. And importantly, do not panic. Because it can still take the rest of its, remember, it's 37 feet long. It can take the rest of its body, wrap around you. Do not panic. Can anyone actually do this?
No. Has anyone tried this?
It's in the book. Someone must have tried it. So here we have to imagine, okay, why does this? So the anaconda, it doesn't have arms. It can't shove you in its mouth, right? So it's got to, what it does is if you take a wet plastic bag and you open it up, right, it creates a suction. It creates a suction. So what it does is, as it opens its mouth, you will move into its mouth. It doesn't have to move over you. You move into its mouth. Right? And remember this: be still.
Unconscious at this point.
Don't be unconscious. That's a bad action right there. This will take a long time. Is everyone ready? Oh.
I'm dying to know where you're going.
So after it's fully swallowed your leg, remove your knife, kill the anaconda. So why do you wait?
It's defenseless.
It's defenseless. Its mouth is, you can't do anything anymore. So
Can't back up.
can't back up, it's stuck.
Yeah, how?
But you had to have a knife.
This is the number one thing. You gotta have your knife. So what you do is what's that?
Shouldn't that be number one?
Right. We'll get there. You're getting ahead of yourself. So then you got to take and cut the anaconda's hand off and kind of pull them off like, you know. So why do we put this in here? It's financial literacy. What does an anaconda have to do with that? That's absurd. All right. So see this? So remember the two monks? Okay. This is kind of that same story, without the monks, with a snake instead. So everything is in your head. All the stuff, all the nerves, all the, oh my God, this is the end of the world. It's all in our heads. It's our minds. It's not the market. It's not. So this much I know. Right here, it's going to begin swallowing your money. You need to be calm. So you have to be sure you have your knife. It does. I mean, think about 2008. You felt like it was the end of the world. People lost a lot of money. Oh my God, when's it going to end? The wrong behavior is to panic and run, which means sell everything, right? And there was actually, I think it was, I don't know if it was New York Times or Wall Street Journal, there was an article, and this was a success article, right? Clients, this couple, and there's a picture of them, they're excited that they've sold everything at the bottom. And they're happy that they don't have to deal with the emotions, and they're better off having done that. This is, right? That was absolutely the wrong thing to do, right? So what is your knife? This is your question, right? In this circumstance, what's the knife? Because it's not a snake we're talking about. This is what I think it is. Principle-based portfolio strategy that you can have faith, patience, and discipline with. Right? If you have a plan, you will theoretically have done the work, you will understand what you could lose so that when you do lose it, which will happen, you'll be prepared for it. You'll know what to do. And so we're going to go over 6 things. You can see them all here. Diversification, blending, globalization, picking great managers, managing risk, after-tax returns. If you look at a mutual fund prospectus or any advisor or anyone out there that's reporting their performance, do they show you that?
No.
Is that information available anywhere? No.
Because everyone's tax rate is different, so they won't.
That's part of the reason, right? So that gives them an out, why they don't have to show you, because everyone's tax rates are different, right? Nothing else matters besides after-tax returns. Nothing else matters, right? So if you're not factoring in taxes or thinking about taxes, then you're sort of missing the point. Okay. So what does this mean? Diversification across different asset classes. So notice there's no additional disclaimers down here. The reason that is because I took out the things that they wouldn't let me put there. So I had things like global macro. I had things like covered call kinds of things. But once I talk about options, then it's got to be one-on-one, and I'm not allowed to talk about it anymore. So I'll name those things as alternative true diversifiers. But traditional, when you talk to a broker, you talk to anybody, they're going to give you a portfolio that's got 9 asset classes in it. They're all going to come out of here. There's something we're not going to go over today. I'm just going to mention this. But there's a reason that this worked. And what this is stocks and bonds. There's a reason that worked for the last, 30 years, since 1982. Can anyone tell me what the reason is? Why did the mix of stocks and bonds work for the last 30 years? No one knows? Every single time there's been any kind of hiccup in the markets, we've flooded the universe with capital. We've lowered rates, we've made it cheap to refinance things, made it cheaper to buy stuff. The cost of capital came down, year over year over year over year from 1982 to today. And so every single time your stocks did poorly, your bonds did well. And that's literally every single bear market. In equities, bonds did well. Okay, that will not happen again. That is over. Okay? That's why you have to start adding this. We're going to get more specific into some of these soon. So why is that over? And you know what? I'm not going to say it's over today. It's over in the next year or so. I don't know when it actually ends. No one knows. It's impossible to know. And the reason is we're at the zero bound on rates. We can't go lower on rates. And if we can't go, the way bonds work if interest rates go down, bond values go up. That's math, okay? Trust me. Right? So if interest rates go up, bond values go down. And if the direction interest rates are going to go here forward are up, which is the only direction really available to them, there's a little bit more room on the downside, not a lot. But if the only direction they can go is up, then the only place bond values can go is down.
So what you're really saying is we're at a particular point in the cycle.
Yep.
It's not that it never will happen again. It's
No,
just
right.
Right now, we're so low that...
So how the cycle plays out is, right now we've flooded we've flooded the economy with capital. So inflation is going to pick up. We're going to have to raise interest rates to fight off inflation. We don't know how high that goes, but then we'll raise. Last time this happened, we had to raise interest rates to 15, 16% because inflation was that high. And then from that point on, 1982 till today, we just ticked it down as inflation was down. So this has happened before. This is not new. We've done this before. We put a lot of money into the system in the past, and we had a lot of inflation, and we had to pull it out. Rates go up. So that's kind of how that plays out. The thing I don't know is I don't know when it goes up. I don't know how fast it goes up. So there's a lot of unknowns. We don't know how to manage portfolios, except for this part is the number one portfolio behavior out there. Lots of different things that can respond differently to different things, different economic stimuli. Okay? We're going to get into a couple more things. So why do we do that? So why diversify? We diversify because by diversifying, see right here, return. Here, risk, measured by standard deviation. I'll back up from that for just a second. What is risk? We talked about this earlier. This should be a quick answer. What is risk?
Now you have it, now you don't.
That's the perceived risk. That's what we think about. But the real risk is buying power. Okay? That's not how any of these statistics are measuring it. We're measuring standard deviation. We're measuring volatility. So Warren Buffett did a thing once where he said the entire industry measures risk with volatility or beta. And what that is statistics that show up and down and zigs and zags in markets. That's all zigs and zags. Think about it in terms of zigs and zags. Warren Buffett said, risk is not zigs and zags. Risk is zigs and zags plus panic. So if you can cut panic off, zigs and zags are just zigs and zags. So there's no risk in zigs and zags. Okay? So what these do by diversifying, and this is a 100% bond portfolio, 25% bond, or 25% stocks, 75% bond, all the way up to here, 100% stocks. So by diversifying a portfolio, you move this way, that's this way on the graph, which is better return, lower risk. Does that make sense? Diversification provides better return, lower risk over time. It won't happen in this month or next month. Okay. So this is what I wanted to show, right? So diversification, what's it? How does that rubber hit the road? 2008 stunk, no matter what you're invested in. This is the asset allocation portfolio. This portfolio, stocks, bonds, hedged products, market neutral, everything's in it, okay? And it's rebalanced annually. Lost 23% in 2008. Interesting thing, 2009-10, we're already making money again. We've already surpassed our high water mark. So asset, 22.5, so we're almost back to even. We're about 4 or 5, it looks like it's, what is that? It looks like it's 1.3%, but it's actually 4 or 5% because every dollar you lose is a hard dollar to gain, right? If you lose 1%, you have to make 1.2% to get back to even. Math clear? Okay. So, but 2010, you're back to even and you've made money, right? So why is that? Is that because all the things recovered? No. We'll talk about it in a minute. So this, step 2, you blend growth and value. So what these are, 12 months, 5 years, 10 years. What this says is value, growth, the blend. The blend, is that gray?
Yeah.
Aren't they all kind of gray? Yeah. Okay. The one on the far right of all three, that's the blend, and the idea is that beats the S&P 500 that percentage of time. So by blending the two, growth and value, you're more likely to beat the S&P 500, rather than just buying the S&P 500 for the equity portion of a portfolio. So why do I say that? Someone was sitting right back there moments ago and asked the question, how do you pick a good manager? and managers have different ideas about what they invest in. Usually those ideas fall in two camps, and then they fall in more camps below that. Those two camps are growth and value. You've got people that say, we should invest in Genentech, and we should invest in Amgen, and we should invest in these high growth companies. The companies are doing cloud computing and Facebook and social networking. That's where we should invest. Those are growth companies. They're going to grow. So that's why I invest. You have a whole other set of people, at the top of their pyramid is Warren Buffett saying value companies. You buy cash flow, you buy dividends, you pay attention to yield. That's what you look at. Two completely different camps on how to invest. Both of them end up in roughly the same place over time. They just get there in different ways. Okay? So what I'm saying here is blend the two. Don't pick one, because you're going to be right more often by creating a blend than by picking one over the other. Does that make sense? Okay. And the reason that works that way is because they benefit from different parts of a market cycle. So in early market cycle, you got things just taken off. That's when growth works. So if you think about it, different industries have different cycles. So right now, the idea of cloud computing, that has it's in a hyper growth phase. It's so much so that we don't know which companies are going to be successful, right? There's a lot of options, a lot of people feed into that, but we don't know which ones are going to be successful. But if you invest in a bunch of them, you're going to actually make a ton of money there. Probably what's going to happen is this one's going to buy that one, this one's going to buy that one, this one's going to buy that one, then Apple's going to buy the last one. That's what's going to happen. Are there any Droid users here? Oh.
That's the Python.
Can we convert you? Jeez. Join the team. No? Okay. So on the other side, you got value, right? So value is you're buying something that is on a relative basis undervalued. You're buying more earnings for each dollar you use to purchase. So you're buying dividends and yield, not future growth of the company. You're buying today, what are they doing? So a good story in that realm is the bunch, right? Cisco, Intel, Microsoft. Those three used to be massive growth companies. Now they pay dividends, and now they're growing. They're doing great stuff. Their earnings are up, but they're not hyper growth companies. It's not new technology. Microsoft hasn't invented anything new for a long time, right? But everyone still uses Office. Everyone still uses Office, right? No? What do you use? I have Office on my Mac. Of course not. Okay. I didn't know there was another option. There's Google Docs, but that crashes half the time. I've tested it. Step 3. The idea here is there's stuff that we buy and use every single day that's manufactured by foreign companies, or it's manufactured by a US company that is actually owned by foreign companies. Right? That's all these brands are foreign owned. And there's nothing wrong with that. I'm actually a huge fan of globalization. I am not worried about outsourcing manufacturing jobs. I think it's a beautiful thing. Why? Because I'm going to get feedback, I know it. What are you laughing at? So why do you think, why am I okay with that? Who's the beneficiary of that? That's it. And ultimately, if the consumer's the beneficiary of that, who else is the beneficiary of that? Other businesses. So if I have $100 to spend, and I could spend $100 on something manufactured here, or I could spend $80 on something manufactured there and $20 more on something manufactured here. And what if the company that owns that thing manufactured there is actually a US company? So I'm actually feeding earnings back to here. I get the best of all worlds there. There's an area of employment that no one cares about anymore that used to be 98% of the employment. You know what area that is? Farming. It's 1.5% of our employment now. No one is concerned about that now. Why is it such a small percentage of overall employment? Mechanization is part of it. Technology is part of it. The reason I bring it up in terms of employment is farming is a low value added job. You can't add a lot of value in farming. And it's not a bad thing that we don't add a lot of value in manufacturing either, right? We don't add a lot of value in manufacturing because there's machines that do that now. Machines are replacing people there. The failure isn't that we don't have enough manufacturing jobs. The failure is we don't have enough retraining. That's the failure, because it's actually good for the planet that manufacturing is, think about, one of the things we tried to do 30 years ago when we started this whole process of globalization is we try to create consumers in the emerging economies, okay? So they've been manufacturers and producers, and they have not been consuming forever and ever, you know. We're living right now through probably a 5-year period where those economies become consumers. There are as many people as are in the United States are entering the middle class in the emerging markets. There are as many people entering the middle class in the emerging markets as exist in the United States now, and that's a huge boon for economies. The reason that I have faith is because I know those people are just now starting to consume. Now there's environmental issues we have to deal with that consumption, and there's waste issues we have to deal with that consumption, and we'll deal with those issues. I'm not worried about that. It maintains you are worried about that, obviously?
Yes.
Okay. But you know, we will resolve it. We are resolving it. There's new packaging technology, actually, you know what, I'm gonna recommend a book right now. Hey, there's a book that was published February 17th called Abundance. Buy it. That's the end of my recommendation. All kinds of reasons to be positive right now. All right. So usually before this slide, I have another slide, but it's outdated, so I didn't leave it here. And what that slide basically did was it took a 20, 30-year period, all the volatility zigs and zags, put the European market right next to the United States market. And we ended up in the same place over the time frame. We got there in totally different ways. So the reason you diversify and globalize is this. Because they get there in different ways, it reduces volatility. So this slide is 07, so this is outdated, okay? So this percentage could be a little bit higher, a little bit lower, but the concept is the same. If you have 30 to 40%, 50% of your stocks or the equity portion of your portfolio is in equities, that will be the maximum amount of volatility reduction you can create. So we talked about this earlier. The issue, you know, ideally, we'd all invest in equities and go forward. Our stomachs can't deal with that. So we need to find a way to keep ourselves in the game. So what we do is we reduce volatility, and the way to do that is to blend out volatility. Adding international companies blends out volatility. That's why we do it. Make sense? So the last step 4 is identify great managers. Well, can't I just pick the ones that did well last year? No, you can't do that. This is why. So there's reversion to the mean. Everyone knows what that means, right? Things that do really, really well eventually come back to average. Things that do really, really poorly come back to average, right? Somehow, some way, it happens. And this is why we say this. Past performance, not indicative of future results. Everyone knows that, right? So these are the best managers. And again, I took a period that was great, and then I put in the .com collapse. So great period, .com collapse. 4 years and 4 years. 129 managers, top 25% of all managers. The next period of time, pretty equally distributed. And this is only slightly tilted, but the majority of them, 3rd and 4th quartile managers. Why does that matter? Past performance is not indicative of future results. Okay? I'm going to make a joke about that later, but I'll let you wait for that. Okay? So how do you do it? How do you pick great management? And I'll say this, because I'm not allowed to actually put it up there. Ideally, not ideally, there are managers that are good in places, but in a place where it's a really efficient market, say a large cap value, stuff that Buffett buys, an ETF, you don't pay a manager for that because there's no value they can possibly add. Okay? So there's this huge industry of managers. We use a couple different kinds of analysis. We're not going to go into the math or any of that kind of stuff. We're just going to point out a few things to look for. So when I first started in the industry, the thing that they talked about was this, style drift. What that means is if I'm building a house and I hire someone to, you know, put the pool in, I don't want them working on my electrical. Right? Managers are really good at a thing. They're really not very good at other things. So hire the manager to do large cap value, make them do large cap value. If they shift out of that and start buying growth companies, they're cheating, fire them. They will eventually burn you. Okay? So you hire a manager for a specific role, have them fill that role, don't let them shift. Sharpe ratio. So a lot of times a manager will create an incredible amount of return. And they'll go, and people, you know, they'll publish that, and they'll say, look how good I did, and that'll attract a whole bunch of money. right? Because when you publish it, and even though it says past performance, no guarantee of future results, money follows great performance. And the interesting thing is that manager could have taken an incredible amount of risk. And I'm going to use an example. I think I talked about it earlier with somebody, John Paulson. Everyone know who that is, John Paulson? No one? Does anyone know who that is?
Wasn't he the guy who invested at the bottom of the market?
No.
In 2008?
He's the guy that shorted the housing.
Yeah, right. Yeah.
Right. John Paulson was the greatest trade in the world. It's not Michael Lewis. His different book was written about him. So he has the greatest trade and the most negative time in my history in the industry. Right. So he did phenomenally well. And then shortly thereafter he shorted housing, made a ton of money. We're talking, thousands of % for his investors. Okay. And then 2 years later he invested in gold, made a ton more money. Guess how he did in 2011? He lost 51%. He lost half of his money. Now, how much money do you think flowed into him in expectations of future return, like in early 2011, late 2010, after he made all his money? 70% of his asset base, 70% of the money he managed came in after the fact. And they all lost half their money. Okay? There is no past performance. It's not indicative of future results. And I'll use an analogy that you should all be able to, right? You can't step into the same river twice. The economy changes constantly. The rules of the economy change constantly. Investment rules change constantly. You can't step into the same river twice. So you shouldn't expect past performance to have anything to do with future results. So that adjusted Sharpe ratio talks about how much risk they're taking. They basically take a measure of their performance, right, and minus out volatility. So how much value are they adding for the risk they're taking? Right? So it gives us a way to compare managers accounting for the risk they're taking. Because if you have someone that takes 120% of the risk, you should get 120% of the return. If they take 120% of the risk and you get 115% of the return, it looks better than the manager that takes 100% of the risk and gets 100% of the return, but he's not doing as good a job, right? So that's that comparison. One-off comparisons, there's a manager that I absolutely love who does an incredible job and I've used for years and years and years and years. And I'm doing a one-off comparison on them right now because their performance in the last 5 years is their outperformance in the last 5 years is entirely attributable to one stock. What stock?
Apple.
That's right. Yep. They do incredible all the time. So they perform with their index, but all their outperformance is explained by a single stock. Not necessarily a repeatable process. So when I interview managers, one of the questions I always ask is, what is your sell discipline? You own a stock, it does really well, why do you sell it? I want to know the answer. You own a stock, it does really poorly, why do you sell it? What makes you sell it? And if it's, well, we take our pulse and see how we feel about it, it's not good enough. You want to have someone that actually has a discipline. If we set a target of $300 on the stock, it goes to $320, we're surprised by that, we do a complete analysis, then we make a decision whether we extend that to $350 or we sell it at the point. I want to have a very well thought out sell discipline. Oftentimes, I'll ask on the downside that it's tied to volatility. So I'll say, so you buy the stock, it goes down 10%, market goes down 15%. Did you expect that differential? Is it a market kind of performance or is it supposed to move less than markets? If it's supposed to move less and it goes down more than markets, do you sell it? What do you do? How do you control that? That sell discipline is critical. And the reason it's critical, and I'll tell you why I'm so passionate about the sell discipline, is my father owns, when I was 7, he owned 4, 8, 9, something like that. When I was young, he owned 4 or 5 different small cap. I should preface this by saying I love my father. Okay. He owned 4 or 5 different small cap growth funds. And by the time I was 15, he made so much money in those funds, it was awesome. By the time I was 20, he was back to break even, right? If you never take a gain, you're never going to take a gain. You should take your gains. You should rebalance into other things. This is my early training. So always and everywhere manage risk. And there's 3 ways to do that. And this last one, the second one right here, is more important today than ever in our history. Because remember, up until now, we've always had bonds in there to support us, okay? So independent research. So my custodian, the place where my clients host their money, is LPL. LPL is the biggest independent broker-dealer out there. They don't manufacture their own products. They don't have any sort of investment banking relationships. That's why I use them as my custodian. But it's not good enough for me to read their research and pay attention to what they say, right? I want to listen to Standard & Poor's, also independent. Morningstar independent. Northern Trust does great domestic stuff. JP Morgan has global reach. AllianceBernstein has global reach. And I read probably 15 others. The point of this is, if I read just, his name is Jeffrey Kleintop. You can actually follow him on Twitter. If I read just LPL Financial and just listen to Jeffrey Kleintop, he's always positive. There's always a reason out there that things are going to go well. If you ever want to get a real good handle on the negative side of things, I didn't put this up there, but John Hussman, Hussman Funds, he writes a weekly commentary. He is one of the most analytical and negative people out there. It's awesome. The stuff he says is just, it's awesome, because he's very statistically driven, and if you're negative and you want to have backup for your negativity, John Hussman's your guy. Because we all pick our own person. What I'm going to say is read them both. You have to read a lot, and then you have to kind of take it all in, think about it, and you have to decide, or you have to think about it and make a decision. But it starts with that independent research. Another part of independent research is you cannot trust Bank of America, Merrill Lynch, Morgan Stanley Smith Barney. I don't care if there's a wall between investment banking. Any firm that has product and sales force, sell side is just, it's not worth thinking about it, right? Any firm that has investment banking and sales force, you got to question it. So you have to question these down here. You have to question them. But it takes someone like that to have that global reach. I mean, they have analysts in every country. I don't have that anywhere else. Okay. So alternatives. Does anyone have a sense of what alternatives are before I complete the slide? You know what an alternative investment is? Long short, does anyone know what that is? Okay, so I'm going to start by saying when you own a stock or own a bond, you're long. Okay? Long. If you borrow it for someone else and sell it, you're short. The benefits, if you're long and markets go up or that investment goes up, you make money. If you're long, markets go down or that investment goes down, you lose money. If you're short, the reverse happens. So if you want to make money in a falling market, you want to be short. So this is actually really, really simple, and I'll never explain it so it's simple, but it's not a complex thing. Okay? It's just the reverse side of the trade. So long short is you're giving a fund manager or an ETF the ability to both go long and go short. So they pick the things they like, they buy those. They pick the things they don't like, and they short those. Okay? What that does is it pulls out market risk. Okay? So what do I mean by that? If I'm 100%, if I'm 50% long and 50% short, then whatever the market does, I move with, I'm actually steady. I don't move with the market. Because this part of my portfolio goes up with the market, this part of my portfolio goes down with the market. The way I make money is being right on the individual securities inside. So in that instance, 50-50, that's called market neutral. Okay, that's an alternative asset class. That's a strategy. So different asset classes are commodities, right? Gold, silver, pork bellies, orange juice, that's commodities. Currency is actually one of the most heavily traded markets out there. Real estate, we talked about that as an asset class. It actually perhaps shouldn't be an alternative asset class, but most people don't have it in their portfolios. Most people have their house, and that's the real estate exposure. Strategies, so these are asset classes you can buy. Strategies are someone's making a decision, has a strategy involving maybe multiple asset classes, right? They might be long, they might be short. Momentum, I don't even know how, managed futures, everyone heard of that? Managed futures traders, they're momentum traders. When things are going up, they buy more. When things are going down, they sell more. They go back up, they buy more, they sell more. And some of them do really well, some of them just take your money. Okay, so we talked about correlation earlier, and the dangerous correlations go to 1. That's absolutely true. International and domestic markets are more correlated now than they were 10 years ago, and that will probably continue to be true. And the more products we come up with, the more correlation we're going to see. That's why we're not mixing just alternative asset classes. We're also mixing alternative asset strategies in there, because strategies can kind of focus on controlling the different correlations. So what is correlation? So here we have the S&P 500, it's 100%. We're going to compare that to the real estate, REIT, R-E-I-T, Real Estate Investment Trust, okay? So correlation is this. 75%, see that 75? Of performance of real estate investment trusts can be explained by the performance of S&P 500. Right? They move roughly in the same direction, in the same magnitude, 75% of the time. That is why you want to have some things that are negatively correlated and things that are positively correlated, low positive correlation, because you want things to move differently. So if I bought global stocks, 96% correlation with S&P 500. So if I just bought those two things and thought I was diversified, not true. These things move the same way all the time. You've got to add some of these other things in there. Why is that? You could buy the S&P 500 and just, fall asleep and ignore it for 20 years and come back and you will have made money. But no one can fall asleep for 20 years. You have to watch, you have to see, you have to pay attention. And if you're going to see it and the volatility is going to bother you, then you want to mix some things in. And you want to mix things in even if they move different directions because you get the opportunity to rebalance. And that's what this is. So what is rebalancing? If I start with a 60-40 portfolio, the 60 does really well, becomes 70% of my portfolio, the other part goes to 30. Rebalancing is taking it back to where it was. Why would I do that? Okay, if things revert to the mean, if things that do really, really well now do poorly later, this is a forced buy low, sell high. No thought process, once a year, once a quarter, buy low, sell high. It automates the process. No second guessing it, no thinking about it. Okay, this is what it is. So when the security you own outperforms, there's a mark there. Say that's 10% gain. When it gets over that 10% gain, you trim it down to that 10% gain. Right? This is how you control your exposure to risk assets. So if you buy a mutual fund or an ETF or a single stock, and that mutual fund, ETF, or single stock does incredibly well, take some gains off the table, reinvest them in the thing in your portfolio that's done the worst. Repeat. So that process, it's a method of dollar cost averaging from your successful investments to your unsuccessful investments. And that takes advantage of reversion to the mean. There are managers out there, and we do this a little bit sort of on the margin, that when they see the thing that goes up substantially, they'll sell half of it and buy the thing that goes down. Or they'll sell a bigger chunk. I don't usually make that kind of bet because I believe in reversion to the mean, but I don't believe in it now, or I don't know when it's going to happen. So I like the consistent, sort of brainless approach to it. Because your brain gets in your way more than it helps you when it comes to this kind of stuff. So this is actually, these are different methods of maximizing after-tax returns. And we're at the hour, so I'm going to go quickly through this. So obviously municipal bonds where they're appropriate. You look at tax equivalent yield. If you Google or Wikipedia tax equivalent yield, it'll give you the equation to look at how to do that. So if your income is of a certain threshold, your tax rates are high, municipal bonds are always going to be a better choice. Arguably relative to Treasury, they're a better choice no matter what your income is right now. Low turnover, the fewer transactions you have, the less capital gains you experience, okay? No short-term gains. Sometimes you have to. If at all possible, don't take short-term gains. Why? And this doesn't matter as much now, but in a year, short-term gains at ordinary income, it's going to be a big deal, right? Very expensive. Harvest loss to offset stocks and bonds. What does that mean? That means if you're going to sell something and take a gain, I'm assuming, if you've done it right, not everything in your portfolio is positive. So take some losses to pair against those gains, so less tax this year, right? You may have to put that, as you sell, you get more capital, you may have to put that in something for a time being, and then 31 days later, you go and reinvest it. And so you have to be out for 31 days, whatever it is you sold, because that's the wash sale, you lose your tax benefit, okay? So putting losses and gains together protects on taxes. Some advanced practices, most people don't do this, and if, less than about 4 or 5 million, it almost doesn't make sense, but If you manage your tax lots, that means if you own 20,000 shares of a stock, but you've purchased it 4 times in the past, know the different prices and times you've purchased it, and you sell, when you sell the one that's most tax efficient, okay? You don't sell first in, first out, which is the standard way. And this is, AllianceBernstein did this study that said, if you avoid short-term gains and delay long-term gains, you can add 0.7% to your long-term returns, okay? Just by managing taxes. Now, this is almost all of an advisor's fee. And so if you do this right, it actually covers that. If you're doing it yourself, you actually just add returns, to your own portfolio, which is fantastic. So the conclusion, slow and steady. The goal of all of this is not to fall in love with any asset class, not hate any asset class. In 2008, if you went to cash, that's because you were afraid and you hated everything. Don't do that, right? Stay diversified, build a portfolio that you can have faith, patience, discipline in. This is the joke, right? Past performance, no guarantee of future results, in exactly the same way as cigarettes might be hazardous to your health. They are hazardous to your health, don't smoke, okay?